Today, we're going to crack open the bank's secret ledger. We're going to look at something called a concentration account, a tool you've probably never heard of, but believe me, it quietly moves billions of dollars every single day. And, as you'll see, it's a really critical and actually surprisingly risky part of our entire financial system.
I mean, just stop and think about it for a second. Think about the sheer scale of a major bank. You've got wires, transfers, deposits. It is a constant, almost chaotic flood of money. So how in the world do they keep track of it all without the whole system just grinding to a halt? Well, the answer lies in a special kind of internal account that really acts as the bank's central command.
You know, the best way to picture this is like a giant high-tech mail sorting room. But obviously, instead of letters and packages, this room is handling money. A concentration account is basically that. It's the central hub, a temporary holding area where all the funds are gathered up and sorted before they get sent on to their final destination. So let's get a little more specific. The keyword here is aggregate. See, these accounts are designed to pool money from all sorts of different transactions into one big central pot. And this makes it incredibly simple for the bank to handle really complex tasks, like clearing payments or settling trades, often within the very same day. So, in a word, it's all about efficiency.
Now, you've probably never heard the term concentration account, right? But I bet you've come across the concept. They actually operate under a whole bunch of different names depending on their exact purpose. Omnibus accounts, settlement accounts, sweep accounts. This variety, it just goes to show you how deeply embedded these things are in the basic plumbing of the financial world.
And listen, we are not talking about small change here. These accounts are the workhorses in some of the highest stakes areas of finance. We're talking private banking for really wealthy clients, massive fund transfers between institutions, and the super complex finances of trust and custody accounts. In all these areas, just enormous sums of money have to move with speed and with precision.
But here's the catch. All of that amazing efficiency, it comes with a major risk. Because if that central sorting room isn't managed with extreme, and I mean extreme care, it can become a place where the money trail just goes cold. And that is a huge problem, because it creates a perfect opportunity for illegal activities like money laundering.
And this brings us to the single biggest danger of them all, a broken audit trail. Think of an audit trail as the digital breadcrumbs that follow every single dollar, showing exactly where it came from and where it's going. If that trail gets broken, accountability just vanishes.
This quote really nails it. The risk just skyrockets when the who of a transaction gets separated from the what. The package analogy is perfect here. Just imagine a box is in transit, but its shipping label falls off. The package still exists, of course, but where it came from and where it's supposed to go is now a total mystery. That's precisely the danger here.
And his visual shows the two scenarios perfectly. So, over on the left, you've got a secure transaction, where the money and the customer ID, the who and the what, are chained together. The audit trail is totally intact. But on the right, that chain is broken. The money is now anonymous, and that creates the perfect conditions for it to be misused.
So how do banks fight back against this? What do? Well, they build a kind of procedural fortress around these accounts. The goal isn't to get rid of these incredibly useful tools, but to make them absolutely airtight. So let's take a look at the different layers of that defense.
Okay, the first layer of defense, it's all about people. You can think of these as human guardrails. We're talking about simple things, like requiring two separate employees to approve a transaction, which creates a really powerful check against fraud. Another one is having an independent person reconcile the account frequently, just to catch any discrepancies. And a hard and fast rule is that customers themselves should have zero ability to direct how these internal accounts are used.
The next layer is all about technology. This is about hardening the system itself. So for starters, customers get no direct access, period. Every single transaction that passes through the account must also be detailed on the actual customer statement, making sure there's full transparency. The system also has to be designed to retain all of this critical data and to automatically flag suspicious activity, like, say, the same name appearing over and over again in transactions.
So I know we've been deep in the weeds of banking mechanics here. But let's zoom out for a second. Why should any of us really care about these back-office procedures? Well, because these rules aren't just for the banks. They form this invisible shield that protects the entire financial system.
And this is really the most important takeaway from all of this. These safeguards, they're not just bureaucratic red tape. They are a fundamental line of defense that protects the integrity of the system we all rely on.
The trust we place in our banks, that our money is safe, that transactions are legitimate, all of that is built on a bedrock of these often invisible rules.